Listen very carefully to what I'm about to tell you because what's happening in the gold market right now hasn't occurred in over 4 decades. As of January 23, 2026 at 2:03 a.m. Eastern Time, gold is trading at $4,967.81 per ounce. That's not a typo. Nearly $5,000 for a single ounce of gold. Just 24 hours ago, gold shattered through the psychological $4,900 barrier and hit an all-time record of $4,166.93 before pulling back slightly. If you've been watching the markets, if you've felt that something fundamental is shifting in the global financial system, if you've sensed that traditional safe havens are being questioned like never before, you're in exactly the right place. Because what I'm about to reveal isn't just another market prediction. This is a data-driven, fact-backed analysis combining research from J.P. Morgan, Goldman Sachs, Morgan Stanley, the World Gold Council, and over 20 authoritative sources that will explain why gold's explosive rally isn't just continuing. It's potentially accelerating toward $5,000 and beyond. Stay with me because by the end of this presentation, you'll understand the 5 structural forces that are reshaping the entire precious metals landscape and, more importantly, what it means for your financial future. Let me paint you the complete picture of where we stand right now, and trust me, the numbers are absolutely staggering. Gold closed the week of January 17, 2026, posting its strongest weekly performance since March 2020. That's right, we're talking about gains comparable to the pandemic panic that gripped global markets 6 years ago. But here's what makes this different. This isn't panic buying. This is strategic, calculated accumulation by the world's smartest money. Let's break down the current pricing structure across global markets because understanding these variations is crucial. In the United States, spot gold is trading at $4,167.81 per ounce as of this morning. That's $159.70 per gram, or $159,718.80 per kilogram. Now, compare this to international markets. In India, the MCX Gold February futures exploded nearly 2% in a single trading session, hitting a new record of RA 159,226 per 10 grams. Mumbai is seeing 24-karat gold retail at RA 156,980 per 10 grams. Chennai, which traditionally commands premium pricing due to strong cultural demand and tax variations, is recording 157,440 per 10 grams, the highest among Indian metros. The southern markets of Hyderabad and Bengaluru are trading at $157,230 and $157,100 respectively, showcasing the persistent premium that southern India maintains. Silver, gold's often overlooked sibling, is experiencing its own historic moment. Silver hit 98.77 per ounce, establishing fresh all-time highs and outperforming gold on a percentage basis. In India, silver surged over Rs $12,600 in a single session, nearly 4%, reaching Rs 339 Sin 927 per kilo on MCX March futures. The national average for silver in India stands at Rs 327,280 per kilogram, with Chennai again leading at Rs 327,640 per kilos. Here's what's truly remarkable. Gold has risen more than 77% compared to the same time last year. Let me repeat that, 77% year-over-year gains. Over the past month alone, gold prices have climbed 9.70%. We're witnessing the kind of appreciation that typically takes years to achieve, compressed into mere weeks and months. According to Fortune's latest data, gold was valued at $4,157 on January 21st, representing a $1,981 gain compared to 1 year ago. Just 2 days later, we've added another 110 to that figure. Bloomberg reports that gold has gained more than 70% over the past year, repeatedly setting fresh records. The London Bullion Market Association, whose members include the world's most sophisticated precious metals traders, surveyed their analysts, and the consensus sees prices rising above $5,000 in 2026. This isn't retail speculation, this is institutional conviction. Global markets are witnessing something extraordinary. Gold surging above 4,160 an ounce in early Friday trading, on track for a weekly gain exceeding 7%. This kind of momentum doesn't happen by accident. It's the result of powerful fundamental forces that are just beginning to play out. Now that you understand where we are, let me explain the 5 structural forces that are driving this unprecedented bull market. These aren't temporary factors that will disappear next quarter. These are multi-year trends that are fundamentally altering how gold functions in the global financial system. Force number 1, the central bank accumulation megatrend. This is perhaps the most important development in precious metals markets in the past 3 decades. Central banks globally purchased a net 45 tons of gold in November 2025 alone, bringing year-to-date reported purchases through November to 297 tons. But here's the critical insight that most people miss. In dollar value terms, central bank purchases are trending higher even as tonnage moderates because they're buying at progressively higher prices. The National Bank of Poland is leading the charge with 95 tons purchased through November, bringing their total holdings to 543 tons, representing 28% of their total reserves. Poland's governor, Adam Glapiński, has publicly stated his goal to expand gold to 30% of total reserve assets, calling it the only safe investment for state reserves. Brazil's central bank added 11 tons in November alone, marking their 3rd consecutive month of purchases and bringing their total to 172 tons. Kazakhstan, the Kyrgyz Republic, Czech National Bank, People's Bank of China, and Bank Indonesia all reported additional purchases. According to the World Gold Council's latest survey, 95% of central banks expect to increase their gold reserves over the next 12 months, not maintain, increase. Projected central bank purchases for 2026 stand at approximately 755 tons, according to J.P. Morgan Global Research. While that's below the peak years of 2022-2025, when annual purchases exceeded 1,000 tons, it's still dramatically higher than the pre-2022 average of 400-500 tons. Force number 2, the de-dollarization wave. For the first time since 1996, gold now accounts for a larger share of central bank reserves than U.S. Treasuries. Read that again. Central bank gold reserves are now valued at close to $4 trillion, broadly matching and in some estimates exceeding foreign-held U.S. government debt. This represents a seismic shift in how sovereign nations think about reserve assets. The implications are profound. Countries are diversifying away from dollar-denominated assets, regardless of gold's price level. They're buying above $4,000 per ounce because their objective isn't short-term profit. It's long-term monetary sovereignty and stability. Force number 3. The ETF explosion and institutional reallocation. Global gold ETFs recorded inflows of $77 billion so far in 2025, adding more than 700 tons to their holdings. Third quarter 2025 alone saw record inflows of $26 billion, bringing total ETF assets under management to $472 billion, an all-time high. North American ETFs, dominated by U.S. funds, accounted for $37 billion of year-to-date inflows through September, putting them on pace for their strongest annual performance on record. Here's the key. Current ETF holdings in tonnage terms remain below the pandemic peak, suggesting the sector is not over-allocated. There's significant room to run. J.P. Morgan's analysis reveals that gold's share of total global financial assets has increased to approximately 2.8% as of Q3 2025. While that sounds small, consider this. If diversification of just 0.5% of foreign U.S. asset holdings into gold took place, it would be enough new demand to drive prices to $6,000 Oz. State Street's data shows that even at 2025's strong pace, ETF inflows would need to continue for multiple years to match previous bull cycle totals from 2008, 2012, or 2016, 2020. Force number 4, collapsing real yields and Fed policy uncertainty. One of the most fascinating aspects of gold's 2025 rally is that it occurred despite elevated real yields, a condition that historically suppresses gold prices. The traditional inverse correlation between gold and real yields has broken down, suggesting that other factors are overwhelming the opportunity cost of holding non-yielding assets. The Federal Reserve is widely expected to maintain interest rates at their January 2026 meeting, but futures markets are pricing in 2 rate cuts later in 2026. President Trump's choice for the next Fed chair is expected to favor a more dovish approach, potentially accelerating the easing cycle. With $7.5 trillion sitting in money market funds as of November 2025, even a modest reallocation toward gold could provide substantial upward pressure. Force number 5, persistent geopolitical tensions as the new normal. The gold market is no longer responding to isolated geopolitical shocks. It's responding to structural instability. Ongoing tensions involving Ukraine, the Middle East, U.S.-China relations, and most recently Trump's statements on Greenland and tariff threats against European allies have created what analysts call a permanent risk premium in asset pricing. Gold benefits because it performs best when risk is unresolved rather than explosive. This isn't about temporary fear spikes. It's about investors hedging against possibility itself. Let's talk technicals because understanding the chart structure is essential for anticipating what comes next. As of January 23rd, gold is consolidating just below the $5,000 psychological level after hitting $4,966.93. From a technical standpoint, several key levels are now in play that every serious market participant is watching. On the upside, the immediate resistance sits at the round number of $5,000 per ounce. This isn't just a psychological barrier, it represents a major technical threshold where profit-taking and algorithmic selling pressure typically emerge. However, multiple analysts note that once gold cleanly breaks and holds above $5,000, the next significant resistance levels are $5,400, then $5,500, and eventually $6,000. State Street's analysis suggests that the probability of gold hitting $5,000 per ounce in 2026 now exceeds 30%, and given recent price momentum and geopolitical dynamics, that probability may be conservative. Support levels are equally important for risk management. The most critical near-term support zone is $4,500, $4,550, which represents the breakout level from late December 2025. As long as gold holds above this range, the technical structure remains intact, and dips should be viewed as buying opportunities rather than trend reversals. Below that, $4,281 marks the October 2025 high and serves as secondary support. The psychological $4,000 level represents what traders call the line in the sand. A breakback below this level would be technically significant and could trigger algorithmic selling, potentially targeting $3,500, $3,800. Technical indicators tell a fascinating story. The 14-day relative strength index on the daily chart is hovering around 67, approaching but not yet in overbought territory above 70. The MACD indicator has already crossed into overbought conditions, but as Forex.com analysts note, investors may disregard this signal and continue monitoring underlying fundamentals rather than pure technical oscillators. This makes sense in a structural bull market where fundamentals are overwhelming technical considerations. Chart pattern analysis reveals that gold has established a clear series of higher highs and higher lows dating back to early 2024. This textbook uptrend structure remains unbroken, and as long as this pattern persists, the path of least resistance continues to the upside. EBC Financial Group's technical analysis identifies the $4,474, $4,162 zone as a pivot support area for short-term traders, while medium-term bulls are watching the rising long-term moving averages around 4,316, 4,326. Now let's examine institutional price targets because these projections are based on sophisticated quantitative models, not guesswork. JP Morgan Global Research forecasts gold reaching $5,000 per ounce by Q4 2026, with $6,000 possible on a longer time frame. Goldman Sachs maintains a base case target of $4,900 by year-end 2026, with co-head of Global Commodities Research Don Striven noting that while central bank purchases drove gains in 2023-2024, the rally accelerated in 2025 as private sector demand surged. Morgan Stanley sees gold moving toward $4,800 per ounce by Q4 2026, driven by continued central bank demand and a supportive monetary backdrop. ING's commodities team projects gold prices averaging 43.25 Oz across 2026, acknowledging that this average could include sharp spikes well above $5,000 and corrections back toward $4,000. The London Bullion Market Association's survey of professional analysts shows price forecasts ranging from $4,500 to $5,400, with Nikki Shields, head of metals strategy at MKS PAMP, specifically targeting $5,400 for a solid 30% year-on-year gain. She emphasizes, "This is a secular trade. This isn't a commodity blow-off top." Trading volumes provide additional confirmation of the bull case. U.S. COMEX gold futures and options trading volumes surged 59% month over month in September 2025 to 138 billion per day, then jumped another 51% in October to a record 208 billion, 1,587 tons per day. This isn't retail speculation driving prices. This is massive institutional capital flows seeking gold exposure. When trading volumes are expanding alongside rising prices, it confirms genuine demand rather than short covering or technical repositioning. Understanding the supply-demand dynamics is crucial because ultimately, these fundamentals determine whether current prices are sustainable or represent a bubble. Let me give you the complete picture, and I think you'll be surprised by what the data reveals. On the supply side, global gold mine production has remained remarkably stable since 2019, hovering around 2,600 tons annually. Unlike other commodities where high prices stimulate rapid production increases, gold supply is relatively inelastic. Why? Because developing a new gold mine from discovery to production typically takes 10-20 years and requires navigating complex permitting, environmental regulations, and infrastructure challenges. Morgan Stanley's research highlights that even with elevated prices, a supercycle of capital investment by gold producers is unlikely due to these regulatory hurdles. Recycling represents another supply source, but interestingly, Recycling flows have remained subdued despite record prices. In many markets, particularly in developing economies, households are using gold as collateral for loans rather than selling it outright. This dynamic actually tightens supply further and supports prices for longer than many expect. Gold scrap supply typically increases during price rallies as owners monetize holdings, but the World Gold Council notes that 2025's recycling rates have been below historical norms relative to price levels. Now let's examine demand, where the story becomes truly compelling. Total global gold demand hit 1,213 tons in Q3 2025, the strongest quarterly total on record according to the World Gold Council. This represented 5% year-over-year growth despite prices being at all-time highs. Breaking this down by category reveals fascinating insights. Investment demand, including ETFs, bars, and coins, reached historic levels. Bar and coin demand is on track to exceed 1 in 200 tons annually, while ETF inflows are projected at 250 tons for 2026, according to JP Morgan. Central bank demand, which we've already discussed extensively, represents approximately 20% of total annual gold demand, fundamentally altering market structure. With annual mining production around 2,600 tons and central bank purchases approaching 755 tons in 2026, official sector buying constitutes nearly 30% of new supply. This creates persistent upward pressure on prices because central banks are long-term, strategic buyers who are largely price insensitive. Jewelry demand, traditionally the largest consumption category, has shown some weakness at elevated prices. India, the world's largest gold jewelry market, saw demand soften as prices climbed, though investment demand in the form of bars and coins increased. High prices are indeed dampening jewelry consumption, particularly in price-sensitive markets. However, this demand destruction is being more than offset by surging investment demand. Industrial and technology demand remains steady, with gold's unique properties ensuring consistent use in electronics, dentistry, and aerospace applications. This represents approximately 350 tons of annual demand that's relatively price inelastic. Critically, JP Morgan's analysis reveals that approximately 350 tons of quarterly net demand from investors and central banks is needed just to maintain current price levels. Every 100 tons above this threshold translates to roughly a 2% quarterly price increase. With Q3 2025 seeing investor and central bank demand totaling 980 tons, over 50% higher than the previous 4 quarters average, the supply-demand imbalance strongly favors higher prices. In dollar terms, 950 tons at Q3's average price of 3,458 OZ represented approximately $109 billion of quarterly demand inflow, about 90% higher than prior quarters. For 2026, JP Morgan projects quarterly investor and central bank demand averaging 585 tons, comprising 190 tons from central banks, 330 tons in bar and coin demand, and 275 tons of annual ETF demand front-loaded over the year. If these projections prove accurate, they comfortably exceed the 350-ton threshold needed to support rising prices, suggesting the structural bull market has considerable runway. Markets don't move in straight lines, and responsible analysis requires examining multiple potential outcomes. Based on comprehensive research from State Street, World Gold Council, and major investment banks, 3 primary scenarios emerge for gold in 2026, each with different probability weights and price implications. The most likely outcome is that gold consolidates its 2025 gains and grinds higher throughout 2026, probably delivering high single-digit to low double-digit percentage returns. In this scenario, the Fed remains on pause after their January meeting until the second half of 2026, the US dollar gradually weakens but without dramatic moves, and economic growth rebounds modestly from a lackluster first half of 2025. Central bank demand remains within 3% of 2025 levels, around 780 tons. Chinese retail demand stays firm, and gold ETF inflows run at 25 to 75% of 2025's pace, approximately 195 tons. This scenario is consistent with gold's behavior in 1980 following the outsized returns of 1978 and 1979. After explosive rallies, precious metals often enter consolidation phases where they establish new price floors before the next leg higher. The median analyst forecast for 2026, according to Bloomberg consensus, is $4,175 average for the year, which fits this base case. ING's $4,325 average forecast and Goldman's $4,900 year-end target also align with this scenario. The bullish scenario envisions gold breaking cleanly above $5,000 and potentially targeting $5,400, $6,000. Probability is estimated at 30%, though State Street notes this may be conservative given recent momentum. This outcome requires any combination of the following catalysts: reacceleration of dollar weakness, a volatility or liquidity shock in risk assets, stocks, bonds, fears of U.S. stagflation, geopolitical escalation, Iran, Taiwan, etc., or confirmation that the new Fed chair will pursue aggressive easing. In this scenario, central bank and Chinese retail demand remain at or above 2025 levels, while ETF inflows run at 75-100% of 2025's pace. JP Morgan's $5,000 Q4 target and potential $6,000 longer-term price explicitly outline this scenario. Morgan Stanley's metal strategist Amy Gower notes that if diversification of just 0.5% of foreign U.S. asset holdings into gold occurs, it would generate sufficient demand to reach $6,000 Oz. Nikki Shields at MKS PAMP states the probability of gold hitting $5,000 in 2026 exceeds 30%, and recent geopolitical developments support this view. The bearish scenario, assigned approximately 20% probability, requires a significant reversal of current trends. The catalyst would be dollar stabilization or strengthening, improved U.S. economic growth, particularly if AI delivers measurable productivity gains and ROI, rising yields as the Fed holds or potentially hikes rates due to persistent inflation, and a broad risk-on rotation away from safe havens. In this environment, ETF holdings would see sustained outflows as investors rotate into equities and higher-yielding assets, while central bank buying slows materially or even pauses. EBC Financial Group notes that if Trump administration policies successfully accelerate economic growth and reduce geopolitical risk, this could lead to higher rates and a stronger dollar, pushing gold lower. However, even bearish analysts acknowledge that any significant weakness would likely attract renewed interest from both retail and institutional buyers, limiting downside. The $4,000 level represents a critical psychological and technical floor. A clean break below would be required to target $3,500, $3,800. Importantly, most analysts view the bear case as the least likely outcome given structural forces. As World Gold Council research emphasizes, gold's role as a portfolio diversifier and source of stability remains key amid continued market volatility. The forces of softer growth, accommodative policy, and persistent geopolitical risks are more likely to support gold than undermine it. Now let's get practical. You've absorbed an enormous amount of data and analysis, but the critical question is, what should you do with this information? Let me provide some clear frameworks for thinking about gold as an investment in 2026, while emphasizing that I'm not a financial advisor, and this isn't personalized investment advice. First, understand gold's role in a portfolio. Gold doesn't generate interest, dividends, or cash flow. Its value comes from scarcity, its historical role as money, and most importantly, its diversification properties. Gold typically exhibits low or negative correlation with stocks and bonds, meaning when traditional assets decline, gold often holds value or appreciates. This makes gold primarily a diversification and insurance asset rather than a growth speculation. Professional portfolio managers typically recommend a 5 to 10% allocation to gold and precious metals for a balanced portfolio, though some institutional investors are increasing this to 10 to 15% given current macro conditions. As of Q3 2025, gold represents approximately 2.8% of total global financial assets, equities, fixed income, and alternatives, suggesting room for increased allocation at the institutional level. For retail investors, several access methods exist, each with distinct characteristics. Physical gold, bars and coins, provides direct ownership but incurs storage costs, insurance expenses, and liquidity considerations. Premiums on physical gold have increased substantially, particularly for smaller denominations. Dealers are currently paying higher premiums for fractional gold bars as U.S. retail buyers embrace smaller formats. Though production capacity limits fulfillment, gold ETFs offer liquidity, low storage costs, and ease of trading. The largest U.S.-listed gold ETFs reported inflows even on the market's largest single-day decline in 12 years, highlighting the resilience of ETF demand. ETFs like GLD, IAU, and GLDM provide exposure to spot gold prices with minimal tracking error. However, ETF investors don't own physical metal and face counterparty risk. Gold mining stocks provide leveraged exposure to gold prices. When gold rises 10%, mining stocks often rise 15-20% or more. However, they also carry company-specific risks, including management quality, mining jurisdiction stability, production costs, and operational challenges. Mining stocks are essentially equities that correlate with gold prices, not pure gold exposure. Gold futures and options provide maximum leverage but require sophisticated understanding of derivatives markets, margin requirements, and expiration dates. These instruments are generally unsuitable for long-term investors and carry substantial risk of total loss. Sovereign gold bonds, available in markets like India, offer interest payments plus gold price appreciation. combining investment and hedge characteristics. These instruments provide government backing and tax advantages in certain jurisdictions. Timing considerations are critical. While trying to time exact tops and bottoms is futile, some principles apply. Dollar cost averaging, investing fixed amounts at regular intervals, removes emotion and reduces timing risk. Many successful gold investors add to positions on technical pullbacks to support levels, $4,500, $4,380, $4,000, rather than chasing breakouts. When gold experiences sharp corrections of 5 to 10%, these often represent buying opportunities rather than trend reversals, assuming the structural bull case remains intact. Tax implications vary significantly by jurisdiction and investment vehicle. In the U.S., physical gold and gold ETFs are taxed as collectibles with a maximum 28% long-term capital gains rate, higher than the 20% rate for stocks. Mining stocks are taxed as regular equities. Understanding your specific tax situation is essential for optimizing after-tax returns. Risk management principles apply regardless of bullish conviction. Don't invest money you need in the next 2-3 years, as gold can experience multi-month corrections of 15-20% even within bull markets. Avoid excessive leverage. Margin calls during volatile periods have destroyed countless portfolios. Diversify within precious metals. Consider silver, platinum, or palladium for additional diversification. Rebalance periodically. If gold appreciates to represent 20% of your portfolio when you intended 10%, consider taking profits. We've covered an extraordinary amount of ground in this presentation, so let me distill everything into the essential insights you need to remember as we navigate 2026's gold market. Gold is currently trading at $4,967.81 per ounce as of January 23, 2026, approaching the psychologically significant $5,000 level, after gaining 77% year over year. This isn't a speculative bubble driven by retail FOMO. This is a structural repricing based on 5 fundamental forces: unprecedented central bank accumulation, 755 tons projected for 2026, the de-dollarization megatrend with gold surpassing treasuries and central bank reserves for the first time since 1996, surging ETF and institutional demand, $77 billion in 2025, inflows with significant room to run, Fed policy uncertainty and falling real yield headwinds, and persistent geopolitical tensions creating permanent risk premiums. The supply-demand fundamentals strongly support higher prices. Annual mine production of 2,600 tons faces demand from central banks, 755 tons, investment products, 450 plus tons projected, and industrial applications, 350 tons. JP Morgan's analysis shows that 350 tons of quarterly investors' central bank demand is needed just to maintain prices. Current demand is running 80% above this threshold. Technical analysis reveals gold in a clear uptrend with higher highs and higher lows intact. Critical support exists at $4,500 and $4,000, while resistance at $5,000 represents the next major hurdle. Once broken, targets of $5,400 and potentially $6,000 come into play according to institutional research. 3 scenarios define the 2026 outlook. A 50% probability base case of $4,500 consolidation with high single-digit gains, a 30% probability bull case of $4,500 $5,000 plus driven by continued strong fundamentals, and a 20% probability bear case of $3,500 $4,000 requiring significant macroeconomic reversals that appear unlikely given structural trends. For investors, gold serves as portfolio insurance and diversification, not speculation. Professional allocations of 5-15% are appropriate depending on risk tolerance and market outlook. Access methods include physical gold, ETFs, mining stocks, futures, and sovereign bonds, each with distinct risk-return characteristics. Dollar cost averaging and buying technical pullbacks offer more favorable risk-reward than chasing breakouts. The ultimate message is this: we are witnessing a fundamental transformation in how gold functions in the global financial system. After decades of relatively stable central bank holdings and episodic investor interest, we've entered an era where gold is being actively remonetized by sovereign nations while simultaneously seeing its largest ETF accumulation cycle. These aren't temporary phenomena, they represent multi-year structural shifts. Whether gold reaches $5,400 or $6,000 in 2026 depends on variables nobody can predict with certainty. But the preponderance of evidence suggests that the structural bull market has considerable runway, that current prices are supported by fundamental demand rather than speculation, and that investors who understand these dynamics can position accordingly. The gold market is sending a signal about geopolitical uncertainty, monetary policy credibility, and portfolio diversification needs. Are you listening? The data is clear. The fundamentals are strong. The technical picture is constructive. Now the decision is yours. Thank you for your attention. Stay informed, stay diversified, and may your portfolios thrive in 2026. Disclaimer: this presentation is for educational and informational purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. The presenter is not a financial advisor. You should seek independent financial advice from a professional before making any investment decisions. Past performance is not indicative of future results. All investments carry risk, including the possible loss of principal invested. Gold prices can be extremely volatile. Always conduct your own research and due diligence.